Welcome to Objective 2 in Unit 1 of Accounting 3310. In this objective, we're going to have an introduction to the debit and credit terms that are fundamental to financial reporting in a corporate setting. Our objective here is that you'll be able to relate the debit and credit convention to the fundamental accounting equation. These are not just random terms. They have a meaning that is directly derived from that fundamental accounting equation. And then, once we're really solid on what they mean, we'll see how they can be used to describe economic events. Sometimes people wonder why we need debit and credit terms if people already know that assets equal liabilities plus owner's equity. In fact, they aren't something that confuses things. They're something that helps to clarify accounting. And I hope at the end of these next couple slides you'll see why too. First of all, let's think about what happens when an asset increases. There are really only three possibilities. If one asset in the company increases, then there must be a decrease in another asset. As in, when we purchase equipment with cash, we get the equipment, an asset goes up, and another asset goes down, the cash. Or we could have the case if we purchase equipment on account, we could have an increase in the asset of equipment and an increase in liability because we owe money for that equipment. That balances too. And finally, we could have, when one asset increases, an owner's equity account increase. So, for example, we could have a sale for cash in which we record revenue that increases owner's equity, and we have an increase in cash payment at that time. Those are the three possibilities. If an asset increases, one of those three things must happen if our fundamental accounting equation is going to stay balanced. Now, let's go on to the next element, liabilities. When a liability decreases, one of three things must happen. We could have a decrease in an asset. That's what happens when debt is paid. We decrease the liability because we've used some of our assets in providing that cash to the lender, and so now we owe less and we have fewer assets. Or we could have another liability increase. This could happen if we owe someone in the short term and we trade them for another liability. So the accounts payable goes down, and now we have a note payable that gives us more time to pay. So instead of paying off the one liability, we've substituted another liability for it. That can happen. Or we could have an owner's equity account increase when a liability decreases. This could happen when we pay off our liability. We might not have enough cash to pay it off, but instead we offer them some ownership interest in our company. They're glad to accept that, and so we have an increase in owner's equity and a decrease in the liability. Those are the three possibilities. There's not anything else that can happen when a liability decreases and still have a balanced fundamental accounting equation. Let's look at the third element. When owner's equity decreases, what can happen? Well, you may not be surprised, but it's the same three items. If owner's equity goes down, then either an asset decreases, as in we might have owner's equity go down when we've got rent expense, and we pay out cash. So we have less cash and we have less owner's equity. Or we could have a liability increase. So if we have owner's equity go down because we have rent expense, we could have rent payable because we haven't paid it yet, and so now we have an obligation to our landlord for rent. We've got a higher liability. Or finally, an owner's equity account could increase. That is, somehow or other, we could talk our landlord into, instead of our paying cash for that rent expense, we could provide them with ownership interest in our company that increases owner's equity in return for that rent expense. So those are the only three things that can happen when owner's equity decreases. Given those three parallel items, we end up with two groups of events. We went through group one. What happens when we have an increase in an asset or a decrease in a liability or a decrease in owner's equity? And for every single one of those events, we identified the other event that could happen had to be in group two. There's a decrease in an asset, increase in a liability, or increase in owner's equity. So whenever one thing happens from group one, there must be something happening from group two. That is an amazing insight that simplifies financial reporting, because now if we know part of what's happened in a transaction, we can identify it perhaps as an increase in an asset. We can automatically go to those group two items, and it will limit the kind of things that could possibly happen in that transaction. So, given that great insight, we can label these two groups. Group one is called a debit, when we have an increase in an asset, decrease in a liability, or decrease in owner's equity. We have a debit occurring. And our group two items, credits, are decrease in an asset, increase in a liability, increase in owner's equity. Now notice here that debit does not mean increase, and it doesn't mean decrease. It depends on what element we're talking about. So, although it's a long definition, a debit is defined as an increase in an asset, a decrease in a liability, or a decrease in owner's equity. A credit is defined as a decrease in an asset, increase in a liability, increase in owner's equity. We are going to illustrate these two definitions by their position throughout the accounting information system. So we will always put debits on the left, and we will always put credits on the right, and that will help us by physical position also know exactly what we mean. These things are consistent. Left, debit, increase in an asset, decrease in a liability, decrease in an owner's equity. Right, credit, decrease in an asset, increase in a liability, increase in owner's equity. Here's the picture, and you have an advantage as online students that you can capture this picture, print it out, post it, make it your wallpaper on your laptop so that you always have it in front of you until sometime during this class it will be second nature to you and you won't have to refer to it anymore. But if you draw a picture of an asset, liability, and owner's equity, in which each one of those elements has a left and a right side, the left is always the debit side, the right is always the credit side. But a debit means an increase in an asset, so draw an up arrow. For liabilities, a debit means a decrease, draw a down arrow. And for owner's equity, it means a decrease, draw a down arrow. And you see that the change in those arrows happens when we cross the equal sign of the fundamental accounting equation. So this can be an easy graphic for you to draw and to remember, to refer to keep track of the definitions of debit and credit. The advantages of this debit and credit organization is that the words increase and decrease, which are familiar words, become very complicated when we're talking about effects of transactions. For example, when rent increases, a company has decreased owner's equity. So paying a higher rent expense means that we have less wealth in the company. And so these increases in expenses and decreases in owner's equity can get very confusing. But a debit to rent expense makes the expense larger, and a debit to owner's equity makes the wealth lower. It is exactly the same thing, and we have unambiguously identified what has happened. There are an unlimited number of different types of assets, liabilities, and owner's equity, and so if we had to think about each and every asset, liability, and owner's equity and learn something different for every single one of them, we would have an enormous job in financial reporting. However, once we know the terms debit and credit, we can describe any transaction very compactly with the same terminology, and we can interpret that terminology then for the particular elements involved. In summary, at least 2 accounts change with every business event. With more complex business events, there may be more than 2 accounts that change, and we call that a compound entry. But there will always be at least 1 change that's a debit, at least 1 change that's a credit, and the sum of all of the debit changes will be exactly equal to the sum of all of the credit changes. That will let us know that we have accurately analyzed a transaction and that we have analyzed it completely, and we haven't left out any elements that have changed, and we haven't had any inaccurate measurements. This is where I'm going to pause our lecture on Objective 2. There are more slides that are specific transaction analysis. So we will pause here. You can review what we've talked about, and if you're ready to go on, I'll welcome you into the second part of Objective 2, where we apply debits and credits to actual transactions. Thank you.